Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the potential impact on the property market and I guess the broader economy that the lockdowns, particularly in Melbourne and Sydney, might have. At the moment, about half of Australia's population is subject to COVID lockdowns, which is a pretty significant proportion, obviously, of the population. And it's very possible that these people, Melbourne and Sydney, could remain in lockdown for several weeks or possibly even several months, as difficult as that is to say, being a Melburnian in lockdown. Now, of course, I acknowledge that the impact of COVID lockdowns can be wide-ranging. Things like dealing with homeschooling, not seeing family, not enjoying your normal pastimes, to even more severe consequences like business failures, job losses, health challenges, mental health challenges, and those sorts of things. So, of course, we all have a tremendous amount of empathy for the various ways that we're all sort of suffering through the lockdown period. And I don't seek to diminish that by any stretch of the imagination, but of course my blog and podcast today is really focused on the financial consequences of COVID lockdowns. So I invite you to keep that in the back of your mind so I don't come across too uncaring when discussing the impact of lockdowns, of course. Okay, so as the saying goes, history leaves clues, and certainly we've been here before. So what have we learnt from previous lockdowns, not only in Australia in 2020 last year, but also globally? I mean, the themes have been rather consistent, and there's sort of four key observations, I guess, that we've learnt from previous lockdowns. The first one is that low-income earners tend to be impacted to a much greater extent. In fact, it's not uncommon for higher income earners to not experience any negative impacts of lockdowns, because typically they can work from home, they can continue working from home, so they get to retain their employment and income. Their expenditure drops because they're not allowed to go out of their home and pursue their normal pastimes. So actually they're in a stronger financial position. Whereas if you compare that to lower income earners, that typically are in industries like hospitality, cleaning services, taxi drivers, Uber drivers, those sorts of people. Obviously, they can't do their job from home, so during a lockdown they lose their income, and they're typically in a weaker financial position, so lower levels of savings and those sorts of things. So it's unfortunate that really COVID exacerbates wealth inequality over time, which could be probably one of the longer lasting economic consequences of COVID, which we're going to have to do something about as a society. Also, the second observation is because people can't undertake their normal sort of, I guess, non-lockdown activities, we really observe two kind of financial trends with respect to spending. The first one is the saving rate spikes. So people are saving more money, putting money in offset accounts, those sorts of things, which is good because it strengthens your personal balance sheet, and also then creates reserves to fund or fuel a return to spending when lockdown opens. Secondly, people tend to spend more on durable goods. You know, they're sort of phones and TVs and appliances and these sorts of things. It's been a really strong trend, a stark trend, really, not only in Australia but around the world, and that's why we see share prices for Harvey Norman and JB Hi-Fi doing incredibly well. I can only imagine the trend will diminish at some point because kind of how many appliances do you need? But obviously, spending on services drops off and spending on durable goods increases. So some sectors of the economy are going to benefit from prolonged lockdowns. Number three, whilst there hasn't been an increase in business failures, or at least it's not reflected in insolvency statistics yet, it stands to reason that every successive lockdown puts an increasing amount of pressure on some businesses, particularly businesses that obviously are greatly impacted by lockdown, like hospitality and so forth. And with each successive lockdown, obviously it depletes their financial resources. They've got less resources to kind of survive or get through the lockdown. So I expect, although it's not reflected in any statistics, but I expect, particularly in Melbourne, because we've had so many lockdowns, we're on to our sixth already, and to some extent Sydney, although they've had less days in lockdown than Melbourne has. I expect this particular lockdown will have a greater impact on insolvencies and businesses going bust. And just anecdotally, walking through the Melbourne CBD, over the last couple of months, I've observed a much greater number of business closures, so empty shops, empty retail premises, those sorts of things over the last couple of months than I definitely did last year. So I think that's going to be particularly centred in CBD locations because in the suburbs, they're probably enjoying an increased level of activity and demand because people are working from home. And finally, the fourth observation is that overall the economic demand post-lockdown tends to bounce back strongly and very fast. So at a macroeconomic level, typically the demand created by higher income earners tends to more than compensate for the lower demand from lower income earners. So that's from a macroeconomic perspective, that's a sort of good outcome. Now, one thing that might be at top of your mind is to say, okay, great, Stuart, we're in these lockdowns, but we don't have JobKeeper. Well, the federal government announced a few months ago what they call their COVID-19 disaster payment program, and that essentially provides a payment of $750 a week for those who have lost more than 20 hours of work due to lockdowns. At the highest point in March last year, JobKeeper was paying $1,500 a fortnight. So really the disaster payment program is on par in terms of dollar value support to those that are being impacted by the lockdowns. Interestingly, Deloitte Access Economics has done some analysis on this and estimates about 2 million Australians have access to this disaster payment, the $750 a week. That's in August 2021, so this month. Compared to in March last year, 6 million people were accessing JobKeeper. So obviously that means there's less money being pumped into the economy through this assistance program. Now, we must remind ourselves that the JobKeeper program was widely criticised for its very untargeted nature. Some businesses like Harvey Norman claimed JobKeeper, then went on to report record profits and dividends. And so, maybe you could argue that, okay, 6 million people really didn't need, they might have been entitled to JobKeeper, but they didn't need it necessarily to get through. So perhaps the disaster payment package is more efficient. I don't know. It'll be interesting to see what impact it will have. But regardless, we have to remind ourselves that the Australian government, federal government, will rack up was tipped a total debt of to reach $1 trillion next year. So they've really spent a lot of money getting the economy through this COVID period. And so I don't expect them to stop now. So if that disaster payment isn't going to do the job, I would imagine the government's going to fiddle with it to make sure that the economy's still in a good position to bounce back when the reopen happens, once that vaccine is sort of rolled through. Another impact of the lockdown will be apartment rental incomes, of course, because holding everything else equal, apartments tend to be cheaper or more affordable to rent than houses. As such, it stands to reason that more lower income earners are renting apartments than they are houses. And whilst that disaster payment, the $750 a week might go some way to minimising financial hardship, it's quite possible that some residential tenants will seek rent relief from their landlords, although there's no, not that I'm aware of any formal program in place to entice landlords to do that, not like it was last year. So hopefully there's less pain. But even if those tenants don't seek any sort of compensation or reduction from landlords, I think it's reasonable to assume over the next couple of years that rental income in respect to apartments, there's probably not going to be a lot of room necessarily to increase rental levels in that sector. Now, let's talk about the property market. The property market at the moment, I think there's enough underlying demand for property buyers, but certainly the confidence levels for vendors remains pretty subdued. And according to realestate.com.au, so the REA group, property listings nationally dropped about 10% in July, with Melbourne and Sydney, particularly Sydney, experiencing much larger falls. Obviously, July we weren't fully into lockdown yet, at least not for the full month, I don't think. One-on-one property inspections can still be conducted in Sydney, but not in Melbourne. So you can't inspect property in Melbourne, and live auctions have been banned in both cities. As such, we saw in Melbourne over the last week of the auctions that were scheduled, about half of them were withdrawn from the market, so postponed. And I think, vendor confidence will really remain weak until the risk of additional lockdowns evaporates, essentially, I think. Because the concern is if I go and put my property on the market, if we're opened up, there's no lockdown, I go and put my property on the market, what happens if that sales campaign gets interrupted by a lockdown? Do I want to take that risk? Because if I'm not under any pressure to sell this year, maybe I'll just postpone to next year and sell when the chance of lockdowns are very remote. Fingers crossed, hope that's the case. And so I think that's how vendors are thinking, and that's where the concern, the primary concern with vendors remains. And so I don't think the property market in terms of supply, so his number of listings, will really return to normal until the risk of additional lockdowns evaporates, which is probably not until next year. So I think that means that demand will continue to outstrip supply in terms of property and housing. Obviously difficult to go through a sales campaign in Melbourne, but you could still do that one-on-one in Sydney. So I don't think prices are going to drop. Maybe they'll continue to rise, but perhaps not at the pace that we've seen in the past. And fingers crossed that the market gets to kind of return to normal, and we'll see. We'll get better statistics about where is the balance, because really the market this year has been characterised by quite low supply. So, of course, demand's always going to exceed supply. One of the challenges that the federal government is going to have during the lockdown will be commodity prices. Because last year the federal budget was helped significantly by the increase in, and certainly the last 6 months, increase in iron ore prices. So really between December 20 and mid-May, the price of iron ore, this is in US dollars per tonne, increased by about 80%. So in December it was selling for 125 US per tonne, and then by mid-May it was up to $215 per tonne, which boosts government revenue through mining royalties and obviously increased income tax, company income tax receipts. However, since the start of August this month, iron ore has really come off quite a lot price-wise. It's now trading at about $160 per tonne. And if that trend persists, that's going to leave a bit of a hole in the federal budget, which might mean greater debt than previously forecast, particularly because of these ongoing lockdowns. That means that they're going to need the support of the RBA through its bond buying program. So the RBA is buying bonds to help state and federal governments fund the COVID response, if you like. Early this month, the RBA said we're going to start tapering off that program, thinking that the governments needed less support, and they were going to reduce their bond buying in September from $5 billion a week to $4 billion a week. But I think, given the landscape's changed since they made that announcement, I think they're very unlikely to taper. off that program, and the RBA has said that they will be quite flexible in dealing with some of these things. So this is going to be important for the RBA to play a role in making sure that you're kind of all in. From a government perspective, a government supports perspective. You can't pull support now because it really unwinds all the good work you did previously. Similarly, in the US, they've been talking about tapering their QE program as well, and that created some jitters in the market. Be interested to see what Delta, what the impact of Delta will be in the US, but I'd imagine the Fed Reserve will react the same way as the RBA and stand ready to provide support when needed. Another trend that's that I predict is going to have a pretty significant impact on at a macro level from a property perspective is interstate migration. Now, I shared a chart, and I've got a link in the show notes and on the blog on the website, but I shared a chart a few weeks ago that showed interstate migration has been negative in New South Wales for quite some time, so people really moving out of Sydney, and has been trending down for Victoria. In fact, the March quarter for Victoria was now negative, pretty significantly negative. So net interstate migration was negative 4,900 people in the March quarter. Compared to March quarter 2020, it was a positive 490 people. So that certainly there's a strong trend of people moving out of Victoria. And I think this trend will continue. So I think more and more people will move from Melbourne and Sydney up to Queensland, whether that's on the coast or into Brisbane. Probably both of those locations will benefit. And I think perhaps even more people from Melbourne. So I think the trend will be even starker in Melbourne, just because the lockdowns and restrictions and economic consequences and so forth have been far more draconian than they have in Sydney or in New South Wales. So they're likely to create more severe social and economic impacts. Now, if that continues, or if that trend plays out, that is, a significant exodus from Melbourne/Victoria into Queensland, what impact does that have for the property market? Well, I think from an overall macroeconomic level, you would say that that's going to have an impact. How much, no one really knows, but I like to make sure my commentary is really aimed at the investment grade market, because really as investors, that's all we're really worried about. And I think it's unlikely to have any material impact on investment grade locations. And the reason why is that these locations tend to benefit from multifaceted demand. So even if one demand factor temporarily subsides, and I think it is temporary, by the way. I mean, things move in cycles. We need to remind ourselves of that. Then if one factor temporarily subsides, it's likely that overall demand will continue to exceed supply, thereby resulting in price appreciation. So I think it will have some impact in some areas, but probably zero impact in investment grade locations. Okay, to sum up then, I predict that the investment grade property market will be largely unaffected by the Melbourne and Sydney lockdowns. Of course, the practicalities of selling means that transaction numbers for probably the rest of this year will continue to be below trend. But of course, there's enough demand to satisfy that small level of supply anyway, so I don't think we're seeing prices fall. Once restrictions are lifted and the risk of further lockdowns disappears, I believe that the property market, particularly in investment grade locations, that is, will quickly return to normal. But supply is probably not going to recover until sometime during 2022. So it's really a bit of a holding pattern, I think, for the rest of this year for investment grade locations. Of course, some non-investment grade locations, particularly ones that are predominantly occupied by lower income earners, may not fare as well. Regarding the overall economy, I think at a macroeconomic level, I think the economy will bounce back relatively quickly, perhaps not as fast as last year, but certainly fast enough. However, of course, there's going to be some sectors that will now take a lot longer to recover. I'm talking years, not months, such as hospitality, retail, particularly in CBD locations, and tourism. So there you go. That's my crystal ball gazing for this week in terms of the impact of the lockdowns on the residential property market, investment grade property market, and the economy. And until next week, bye for now.